Figuring out when to buy and sell investments is like getting the hang of timing in the financial world. Timing is crucial, whether you're diving in to seize opportunities or strategically stepping back to protect your gains. Can you really predict the perfect moment, or is it more about staying in sync with the market's moves? Today in our video, we're exploring the timing of buying and selling investments, a skill akin to dancing with the market's rhythm. It's about making strategic moves that count. Consider the thrill of spotting a promising investment opportunity, the satisfaction of making a wise purchase, or the thoughtful choice of when to part ways with an investment. We'll provide insights and strategies to assist you in making sound decisions, acknowledging the emotions involved in the process. The significance of timing. In the investment world, timing is crucial, like catching the right wave while surfing. It's about choosing the perfect moment for your journey, affecting the overall experience. The feelings tied to timing decisions can range from excitement to anxiety, much like the anticipation before a big event. It's not just about watching the clock, it's the human side of deciding when to buy or sell. Understanding timing is like having a well-tuned instrument, helping investors align with the market's rhythms for better and well-timed financial choices. Market trends and timing. Sailing through market trends is like feeling the rhythm of financial waves, similar to sensing the flow of a river. Timing in market trends is vital, much like catching the right current for a smooth ride. Emotions can fluctuate during these times, from excitement when trends are favorable to concern during shifts. It's not just about the numbers on the charts, it's the human side of deciding when to act. Understanding market trends and timing is like having a compass that guides investors through the twists and turns, aiding them in aligning with the current market flow and making decisions that sync with the prevailing trends. Fundamental analysis and timing. In the investment world, thinking about fundamental analysis is like having a strong base, kind of like knowing what makes a building sturdy. Timing is super important, a bit like planting seeds when it's the best time for lots of good crops. Feelings come into it too, like feeling sure when things match up well, or being careful when things are a bit uncertain. It's not just about looking at numbers on reports. It's about the human part, reacting to how investments are doing. Understanding fundamental analysis and timing is like having a guide, like a compass, that helps investors figure out how strong their money foundation is. This way they can make smart decisions at the right times, all based on really knowing the basics. Economic indicators and their impact. Economic indicators function as the heartbeat of financial markets, much like signals guiding investors through the market's health. Grasping their impact is crucial, similar to interpreting vital signs in healthcare. Emotions can sway from optimism during positive indicators to concern when signals hint at challenges. It's not just about the numbers on the reports, it's the human side of reacting to economic news. Understanding economic indicators and their impact is like having a compass that assists investors in navigating the market's pulse, enabling them to make informed decisions aligned with the economic conditions. Sentiment analysis and market psychology. Investor sentiment is a powerful force that can sway markets, much like the wind guiding the direction of a sailboat. Understanding sentiment analysis is akin to deciphering the collective mood of investors, a bit like tuning into the emotional pulse of the market. It involves gauging emotions from optimism during bullish trends to caution in bearish times. Emotions play a crucial role, much like the ebb and flow of a tide influenced by market psychology. It's not just about the numbers on the charts. It's about the human side of interpreting the feelings and attitudes driving market movements. The art of buying low and selling high. Mastering the art of buying low and selling high is like recognizing the ebb and flow of financial tide. It involves seizing opportunities when prices are down, much like collecting treasures at a bargain. Emotions come into play during this strategic dance, from patience while waiting for the right buying moment to satisfaction when selling at a peak. It's not just about the numbers on the charts. It's about the human side of making well-timed decisions in the market. Risk management and timing. Navigating investments involves finding balance between risk management and timing, much like teeter-tottering on a seesaw. It means weighing potential gains against possible pitfalls, similar to navigating through unfamiliar territory. Emotions play a significant role in this journey. from being cautious about risky moves to feeling relieved when risks are handled well. It's not just about the numbers on the charts. It's about the human side of making wise decisions that minimize potential downsides. Understanding risk management and timing is like having a safety net that guides investors along the market's path, allowing them to explore opportunities with confidence while avoiding potential problems. Seasonal and calendar-based timing. Considering the timing based on seasons and calendars is akin to understanding the natural rhythm in financial decisions, much like knowing when to plant seeds for optimal growth. It involves recognizing patterns linked to specific times of the year, much like anticipating changes in weather seasons. Emotions play a role during this process, from the excitement for potential opportunities during certain months to a sense of caution during traditionally volatile periods. It's not just about the numbers on the charts. It's about the human side of aligning with the cycles of time in the financial landscape. Grasping seasonal and calendar-based timing is like having a reliable calendar that assists investors in synchronizing their strategies with the recurring patterns of the market, allowing them to make well-timed decisions. Long-term versus short-term timing strategies. Investors pick strategies that fit their goals, like choosing tools for tasks. Distinguishing long-term and short-term timing means adjusting plans for specific goals, similar to picking transportation for different needs. Emotions matter, with patience for long-term plans and quick reactions for short-term tactics. It's not just about chart numbers, it's about customizing timing to personal preferences. Understanding these differences is like having a flexible toolkit, letting investors adapt strategies to their unique financial journey. Case studies in timing success and failure. Studying real-life stories of successful and unsuccessful timing in investments is like learning valuable lessons from lived experiences. These examples hold the weight of practical knowledge, similar to lessons passed down through generations. Emotions play a significant role, from the joy of successful timing to the introspection and learning that follow timing failures. It's not just about theoretical concepts. It's about the human aspect of witnessing triumphs and setbacks in the ever-changing financial landscape. Gaining insights from case studies is like having a mentor share meaningful stories, providing wisdom to help investors navigate well-timed decisions and steer clear of potential pitfalls. Behavioral biases and timing mistakes. Recognizing and understanding the impact of behavioral biases and timing mistakes in the world of investments is akin to finding your way through a misty landscape. Acknowledging that the human mind can be swayed by biases that cloud clear judgment is crucial, much like realizing that mist can obscure your vision. Emotions play a significant role in this journey, from the pitfalls of overconfidence leading to impulsive decisions to the hesitations driven by fear. It's not just about interpreting the numbers on the charts. It's about the human aspect of overcoming cognitive biases for well-timed and informed decision-making. Grasping behavioral biases and timing mistakes is like having a reliable guide that helps investors navigate through the mist of emotions, enabling more thoughtful and well-timed choices in the financial journey.